Section 1035 of the Internal Revenue Code is a frequent visitor on the national portion of the life insurance exam, and understanding its mechanics is vital for navigating tax-related questions. At its core, a 1035 exchange allows a policy owner to replace an existing insurance contract with a new one while deferring any income tax liability on the gains. The IRS treats this as a continuation of the original investment rather than a sale and a new purchase. For the exam, you must memorize the specific directions in which these exchanges can flow, because the examiners love to test the exceptions. You can move from a life insurance policy to another life insurance policy, or from a life insurance policy to an annuity. You can also move from a life insurance policy to a qualified long-term care policy. If you have an endowment contract, you can exchange it for another endowment or an annuity. However, the most important rule to remember for your test is the one-way street regarding annuities. While you can exchange one annuity for another annuity or even an annuity for a long-term care policy, you absolutely cannot exchange an annuity for a life insurance policy. If a policyholder attempts to move funds from an annuity into a life insurance contract, it will be treated as a full surrender of the annuity, and all gains will be taxed as ordinary income in the year of the exchange. The logic behind this is that life insurance offers a tax-free death benefit, and the IRS does not want people moving taxable annuity gains into a vehicle where those gains could eventually be paid out entirely tax-free to a beneficiary. When you see a question about the cost basis in a 1035 exchange, remember that the original investment amount stays the same. If a client has a life policy with a $50,000 basis and moves it to a new policy, the new policy starts with that same $50,000 basis. A common exam trap involves the ownership of the policies. For a 1035 exchange to be valid, the owner and the insured must remain the same on both the old and the new contracts. You cannot use a 1035 exchange to change the insured person or to switch ownership to a different individual without triggering tax consequences. Another trick wording involves the phrase like kind. While the IRS uses the term like kind, it is broader than it sounds because it allows a life policy to become an annuity, but not the other way around. To keep this straight for exam day, use the phrase A to L is a no-go. This reminds you that annuity to life is the forbidden path. If you remember that life insurance is the most tax-favored product, you will understand why the IRS lets you move out of it into less favored products, but won't let you move from a less favored annuity into a tax-free life insurance death benefit. Most exam questions will present a scenario where a client wants to upgrade their coverage or find a policy with better features and will ask if they can do so without paying taxes. As long as they are moving from life to life, life to annuity, or annuity to annuity, the answer is yes. Just watch out for that one specific prohibited move. The examiners might also ask about the impact of a policy loan. If a policy with an outstanding loan is exchanged via Section 1035, the loan must be either paid off or carried over to the new policy, or it may be treated as boot, which is a taxable gain. Always look for the word gain in these scenarios, as that is the portion the IRS is interested in taxing. In a successful 1035 exchange, the gain is simply pushed down the road until the new policy is eventually surrendered or matured. By keeping the cost basis consistent, the IRS ensures that they will eventually collect tax on the growth if the money is ever withdrawn, but the exchange itself remains a non-taxable event. Focus on the movement between products and the consistency of the parties involved, and you will master this section of the national exam.